Are people still investing in Toronto real estate? And if so, how are they actually making money? Let's be honest, gone are the days where you can just buy a place, wait, and hope for prices to shoot up. In today's flat market, you need a smarter game plan. So, what's working right now? Who's buying? What are they buying? How are they turning a profit? Well, that is what exactly we're going to be breaking down in this video. If you're new here, we're a Toronto real estate team that helps investors buy smart, value-add multiplexes in the city of Toronto. We work with clients on all levels, from first-time homebuyers to builders, and we're seeing exactly what strategies are working right now. So if you enjoy data-driven content like this, hit that like button, subscribe, and if you want help building your Toronto real estate portfolio right away, book a free strategy call with us. All right, let's get into it. Prices aren't going up like they used to. So if you are going to be investing in Toronto real estate right now, rental income needs to carry its weight. That means positive cash flow from day one, not just hoping for appreciation. The total return has to make sense. And actually, in a flat market, that's not a bad thing. It does force smarter, more stable investing. Now, value-add projects where you take on a renovation or a construction project and the value hopefully will go up by more than how much you put in still works today. And they're probably lower risk compared to a falling market where prices could actually drop in the middle of a renovation and any value-add gain might be wiped out by any market depreciation. Now let's talk more specifically about who is still investing in Toronto real estate today and what specifically they're buying. We're seeing three clear types of investors in today's multiplex space. The first group, under $1 million, turnkey 2 to 3 units, and this is where most investors start. These properties already have multiple units, they cash flow well, and they're easy to qualify for because lenders use the rental income on the subject property before renovations to boost your mortgage approval. And many of these have space out in the back to build a future garden suite or laneway suite too. So there's also that extra room to grow without having to renovate right away. This is the lowest risk, lowest effort way to get solid, steady returns in the Toronto real estate market today. The second group are conversion projects with approximately $120,000 to $250,000 of renovations. These buyers usually have access to a home equity line of credit from another property they own, a HELOC, and more time on their hands and willing to take on the work as well. They buy a cheaper single-family home and then spend money to convert it to a legal 2 or 3 unit property. Now, these projects do take more effort and actually even more upfront capital because renovations also come out of pocket and you can't get a mortgage for that. But here's the upside. Once the work is done, the property is usually worth more than what you put in, like we mentioned with the value-add projects before, and it often cash flows better too. So in this case, you might even be able to go back to the bank, refinance once you're done, and pull out some of your cash that you put in initially. This way, you end up having less money tied up in the property, and then you can move more quickly into another investment, whether it's putting into a stock or saving for another property or even building that backyard house to boost your cash flow even more. If you do, once you add in that garden suite or laneway suite in the back, your rental income will really jump. And that total return on these properties can beat out a lot of other options if it is done right. Now, the third group are the big builds. These are the highest risk, highest cost builder territory projects. Think extensions, additions, top-ups, full new builds, and these are way beyond what most everyday investors can take on. You're looking at a minimum of $300,000 in construction costs, but realistically closer to $1.5 million once all the costs are factored in, and this doesn't include the down payment or closing costs either. This kind of budget is well above most people's HELOC rooms, which is why these projects are mostly done by experienced builders. So if you're wondering, why are builders taking these projects on? Well, a big reason is actually financing. They often can't qualify for a large conventional mortgage or refinance, so instead they build with private money at a higher interest rate, 10% or more these days, but then they plan to refinance afterwards with the CMHC MLI program once the project is done. The MLI refinance allows them to qualify based on the property's rents and income, not their personal income, which does make it easier for them to pull out most or all of their capital once the build is stabilized. And then they just collect monthly cash flow after that. But the MLI Select really is just one strategy, and it is a riskier one. If the refinance doesn't go as planned or if rents don't come in as projected, they could be stuck with a high cost loan with private money and no way to get out. Add that to the fact that no 4+1 multiplexes have actually sold on the market recently, and you've got a major valuation risk too. Sure, on paper, they might be worth $3 million or more based on cap rates. But if the market values them closer to $2.5 million or $3 million, then your return on investment might not be something a lot simpler like a duplex or a triplex with an ADU. The bottom line is that these big builds can offer great cash out potential and solid cash flow if you execute it perfectly. But these projects do come with massive carrying costs, $15,000 to $20,000 a month, uncertain resale value, and a real risk of failure. So unless you are a pro builder with deep pockets and experience, this probably isn't the move for you. So yes, people are still investing in Toronto, but they are being a lot more strategic in terms of what to invest in. Some Toronto investors look all across North America actually for better returns and then end up coming back to Toronto. And this is because the fundamentals here are actually very strong and the numbers are working a lot better than before if you follow the right strategy for you. And it all just depends on your capital, your goals, and how hands-on you want to be and how quickly you want to grow as well. And if you're not sure what makes the most sense for you, we can figure it out together. We're a Toronto real estate sales team that works with investors every single day. Whether you're looking for a simple cash flowing multiplex or a bigger value add project, we can help you spot the right opportunities, run the numbers, and guide you from offer to tenants. So if you want to chat, just book a free strategy call with us and let's build your plan.